Inflation's soft this week. Shouldn't that be the big takeaway? Downside surprises, CPI, PPI, is it that? Or is it jobless claims at 9 months high? Did that spook you at all?
No, not particularly. I think you're right. Like, inflation should be the focus. And I think much credit to the Morgan Stanley economists, who I think have been very consistent on this all year. There's a lot of noise in the data early in the year. They still had a lot of confidence that inflation would be coming down. We're starting to see that very much in the data. And it's all consistent with the idea that we're going to get a cut. We think we're going to get a cut in September, 2 more on the follow after that. And then that should keep Treasury yields moving lower. That should drive a lot of confidence for fixed income investors overall.
That word confidence, I want to play with that just a little bit more.
Yeah.
There's a lot of people that are talking to us at the moment that don't have much confidence in the forecast for unemployment over at the Federal Reserve. What's interesting about that is that actually we used to call their forecast aspirational, and they actually materialised in a very, very favourable way. So it's not to say that it can't happen, just how probable is it that we end with unemployment at the end of this year where it is right now?
Well, I think it's more likely you see it tick up, right, and that's consistent with our economics forecast. But there's a lot kind of undergirding that number, right, in terms of the size of labor force. Obviously, we've seen the size of labor force go up quite a bit with immigration numbers. But as long as inflation is coming down, again, then I think the broader narrative for fixed income investors is going to be, we feel more confident that the next move from the Fed isn't rates higher, or is probably going to be rates lower. And whether or not it's 1 cut, 3 cuts, but we think it's going to be 3 cuts this year, total return tailwinds are pretty substantial in that environment. And it's not even just about government bonds. We really like actually corporate credit in that environment as a way. You're cutting not because the economy is weak, you're cutting because you're getting from restrictive territory to neutral territory. That should be solid for credit fundamentals because the economic backdrop is good. So even though you've got tight spreads, you can earn that extra spread and get even better total returns.